Yes, sir.
Yeah. So myself, Dr. Rakesh Agrawal, Secretary General, Risk Management Association of India. So I welcome you all to this online session on analyzing risk practices. So the insurance industry operates in the world of inherent uncertainties, where managing risk is not just essential but transformative. This webinar for today, analyzing risk practices and within the risks function of the insurance industry, dives into this critical framework of enterprise risk management. Through an exploration of challenges, strategies, and emerging trends, this session hopefully will eliminate how ERM strengthens the financial resilience and operational efficiency. So our esteemed speakers, Dr. Purnima Rao and Dr. Sonjai Kumar, will guide us through this necessity of ERM, global advancements, and implementation in the Indian insurance sector and maybe globally also. So this webinar promises valuable insights for professionals aiming to understand and elevate risk practices in this dynamic industry. So before we start, I'll just give a brief introduction about RMAI, our association. So Risk Management Association is a global body which is dedicated to education, research, and development. This association was formed in the year 1992, and the basic objective was creating a platform for various professionals, insurers, and all from the risk management industry to collaborate, to exchange views and about the risk management industry. So our activities include this online courses on insurance, conducting seminars and workshops. So every month we conduct one or two webinars, and we do a lot of initiatives, awareness stuff, initiatives through various channels and platforms. So we publish a lot of case studies and uh, books also, and we conduct technical paper research writing contests also. And for the members, we publish a quarterly bulletin, which helps them to get updated about the risk management domain. So there's a list of a number of webinars we conduct. This is a sample list. We have conducted many more webinars in past few years. The list of our partners who are associated with RMAI. So we have our members are spread across India and SAARC countries and Middle East. So we have this RMAI course on 30 hours online course on risk management. So in terms of other courses, we have some courses on reinsurance, motor insurance, then generative AI. Recently, we launched a small course on generative AI. So in terms of our associate partners, we have Insurance Times, leading monthly on insurance in India since last 45 years. Banking Finance, again, a journal dedicated to banking and finance industry. Bima Bazaar portal. This is actually not a new portal. It was an old portal, but we have re-christened it maybe 3 months back. So you can say it is a repository of insurance information. So you can visit the site for latest update on insurance, and it covers interview from industry leaders, then various case studies, legal decisions, and it also covers the repository of insurance times for the last 5 years. And we have a special section for consumer awareness and a lot of FAQs on what needs to be done in terms of in the insurance industry. So briefly, I will introduce our today's faculty, Dr. Purnima Rao and Dr. Sonjai Kumar. So Dr. Purnima Rao is a seasoned professional with over 15 years of experience in finance and accounts across industry and academia. She has worked with reputed training organizations such as Motherson Group and Reliance Industries. Dr. Rao has delivered impactful training programs as HIPA, Gurgaon, and IIFT, Delhi, focusing on business research and working capital management. She has also conducted management development programs on emerging finance trends and equity markets for professionals. Her expertise in corporate finance and tailored modules on financial accounting and finance for non-finance executive highlights her commitment to impactful learning. Dr. Sonjai Kumar is a consulting partner at Tata Consultancy Services, leading CRO initiative in India. With 30 years of experience in insurance, actuarial science, and risk management, he specializes in enterprise risk management, risk culture development, and financial risk frameworks. His pioneering PhD in enterprise risk management for the Indian insurance sector reflects his dedication to research with over 50 published articles and research papers. Dr. Kumar is a thought leader passionate about advancing risk management practices in the industry. So I think that was all from my side. So I now request Dr. Sonjay Kumar to share the screen and take the session ahead. And in terms of Q&A, we will have a question answer session at the end of the session around at 5:20. So if you have any question, you can note it down and we can take all the questions at the end. So welcome, Mr. Sanjay Kumar, Dr. Sanjay Kumar and Dr. Purnima Rao.
Yeah, let me just, put my slide on the screen, and then, Dr. Purnima will take it initially
Sure.
and just confirm that, the slide is visible.
Yeah, it is visible.
Okay.
So thank you so much. And okay, if you allow, I'll share the screen because that will help me in controlling the different
You want to share?
points
Okay.
where.
Okay. Let me just, stop it
Yeah.
then.
Thank you so much. Mm. Hi, good afternoon, everyone. And first of all, I would like to extend my thanks, sincere thanks and gratitude to Dr. Rakesh for giving us this wonderful opportunity to interact with I believe, the all seasoned professionals over here and giving us a chance to share the kind of research we have done in last 4 years within the insurance sector. And I'll give you that brief to you how me as an academician and Dr. Sanjoy as from the industry got associated. I am presently working as an full-time PhD program chair and program academics at Fortune Institute of International Business, New Delhi, India. And here we have a doctoral program for working professionals. And we launched this program in 2020. And there I got a chance to meet with Mr. Sanjoy as his supervisor in the area of enterprise risk management. So over a period of 4 years, we both worked together primarily into the area of enterprise risk management in the context of Indian insurance industry to understand that how ERM has been embedded into the insurance industry culture with respect to India. Because we mean it or not mean it, insurance is one such thing that is an integral part of our lives, of all our lives. Even if you see that the case of developed countries where they say that we provide social security to their citizen, it is all because of the insurance companies that are being supporting the government all through the way. And similarly, with respect to the developing countries, there is the kind of risk that presently we all are dealing with. I remember those were the times when people were very hesitant in taking insurance. They were not into that pattern. Now, if you'll see the change that has been happened over a period of time, everybody, nonetheless, everyone, and even government has also granted to the underdeveloped sections of the country for the insurance security for a particular amount. So that's the power of insurance sector. But with that, like Dr. Rakesh has also mentioned at his initial statement while opening the webinar, that risk comes as an integral part. And it's a very important, specifically not for all organizations, but specifically for insurance sector, that how this risk will be managed, how those practices which are being there in the form of frameworks, in the form of best practices across globes are being managed, and what are the loopholes that are being there so that the cushions can be provided, because risk management is nothing but the cushion being provided to the organizations where they can handle the shocks, the uncertainty, because COVID comes as an uncertainty to us, right? So how that that can be provided, that can be medicated. So our whole study, the research that we've done in last 4 years is all about that how risk management practices can actually help support Indian insurance industry, and what are the common practices that are being going on, what is being lacked in those practices as per the standard frameworks given by the international bodies, what are the challenges that companies are facing in terms of implementing those practices. Do they mean to implement but they're not able to because of XYZ reasons that we are able to explore through the extensive interview we have done with the risk professionals. And that set the stage for the development of the idea that we have been worked into the last 4 years, and that sets the flow of the today's presentation that we are going to share with us, the kind of work that we have done over last 4 years, and now we want to share it with everybody, so that the kind of results that we are being able to obtain with the data we have collected over a period of time is known to everyone. Though we have our papers published as well, and some are in pipeline as well, but these kind of webinars provide that open platform to share our research in a very I'll say that layman language way, so that everybody can understand that the concrete points that are being coming out of that. And we have tried to put what next, and there are very interesting outcomes that we are able to generate out of it, and they can have a very important implications for organization and for the policymakers as well. So if I'll talk about need for ERM, so those who belong to the risk part and to the insurance industry, they know that risk is insurance, for insurance industry, it is the inherent part of the business. And how they maintain that risk, what's the cost of the risk that as a consumer has to pay, that's a premium, right? That's how the companies check in for all the risk that they are being getting into. And for that, insurance companies has to maintain certain aspects to ensure that the risk that they are taking by insuring some others business or some other aspects of some others asset, they need to maintain the four important aspects. One is their solvency, profitability, of course, customer satisfaction in terms of services they are providing, and of course the regulatory compliance they need to maintain. And for all these things to go hand in hand, risk management is an essential part of the business from top to bottom. It's risk management is not only the part of the people who are sitting at the top layer and they are just deciding what to do, what not to do. It's the part from top to down. That's the one important findings that we are able to explore, from the top of person sitting at the top of the organization to the person who is actually being part of the operational works. And these things, he or she also need to understand the kind of risk is coming to the business because of his activities that he is doing. So all these things being together, and COVID is something that happened which actually brings up the very adverse effect, and primarily insurance industry is one such industry which is affected very largely out of it, right? And that again necessitates the need for understanding that what is being that needs to be done, why even being the standards are there, what is that which is not being followed, and what an impact the as an ERM practices can have on the financial health of a company, because ultimately it's financial health, it's wealth maximization that is necessary being maintained. There are certain codes that we have been put in, that how government has infused certain amount of capital in different countries, but still their solvency is not as per the mark and lower than the regulatory limit. Further, another capital thing that is IDA has talked about in terms of solvency requirement, they have raised that to 20,000 to 25,000 crore. And that's why within the private insurance sector of the India, mergers are actually observed due to financial viabilities. Moving ahead, this is another thing uh, that I would like to invite my colleague and my scholar and Mr. Sanjay, Dr. Sonjai now, right, to take it up to for the work, and I will pitch in between with respect to the other objectives that come forward. Over to you, Dr. Sanjay.
Yeah, thanks, Dr. Purnima, and just like to confirm that my voice is audible. Yeah, okay. I think the purpose of this slide is basically is to tell that how does the Indian insurance market has basically performed when the stress event happened. And in the Indian market, the COVID was one of the stresses. And this is, the reinsurance losses that happened during the COVID time. And if we look at, the graph, this is the, on the left hand side is the reinsurance profit loss in the year 2017, 18, 18, 19, and 1920. And you can see that the two reinsurance companies, the Munich Re and Swiss Re, were, almost in the profits, right? And of course, the other, Gen Re, Score Re, and Hanover Re were in the losses. But what does the the this COVID did that in the year 2021, when the COVID was on its peak, that all the reinsurance company went into massive losses. If you look at the Munich Re, minus 141 crore loss. If you add, all 3 years of the losses, then this loss is much more than all the 3 years of the losses. Even if you add, the last 3 years of the profits of the Swiss Re, is much more than, the loss that they incurred in the year 2021. And similarly, the amount of losses the other company incurred. So the story was that most of the Indian insurance, life insurance company basically reinsured their, the protection business, especially the term business, to the reinsurance companies, and all the stress event, that happened in terms of the increased deaths that were, shown in terms of, the losses to the reinsurer. It indicates that the market was inadequately prepared, and also that the reinsurance market as well as the insurance market, that the resilience to absorb the shock was not there. So that's the one lesson, one example is definitely there. And in the previous slide, which Dr. Purnima was, showing that the general insurance companies, especially the private, the public sector general insurance companies, are already, having gone through, their the stress time in terms of the capital injection required from the government. So it indicates, that there's a need to strengthen the risk management to the insurance companies so that it can withstand the future losses. Um, I think we also, studied and collated all the information across the world, that what are the common reasons for the failures of various companies across the world. And, these were the reasons that we found that, most commonly coming, whether, it is coming from the US or from the European countries, the poor governance, the poor risk culture, excessive risk taking, lack of risk management implementation, lack of risk identification, herd mentality, mindset issue, lack of transparency, hiding, bad news, showing all KPIs green, failure to spot long-term risk, lack of risk-based decision making, and improper oversight. What you will see is that many of these things, you will find that when we have researched in the Indian insurance market, we found that, couple of things, is missing in the Indian market. It's not just missing in the Indian market, but it's also missing, some other market as well. So these are, the background of it, right? Let's, yeah. So getting back into, the mode of so from the risk management perspective, what historically the insurance company have been doing is the silo risk management. When we talk about the silo risk management, it means that the risk management is being done on an independent basis. That is, for example, the the risk management have been there ever since the insurance company have been in existence, like they are doing, underwriting, reinsurance, claim management, investment. These activities are being done. But these are being done, independently by the independent departments. And there have been, challenges in the silo risk management that it does not give the holistic view to the organization. And also, many of the risks are correlated. And when the silo risk management are considered, that correlations, does not come through. And therefore, some 20 25 years back, around 2000, the concept of enterprise risk management started developing, which has now overtaken all over the world, and silo risk management almost now non-existent. Dr. Purnima, can you move to the next slide? Yeah. So enterprise risk management is across all the entire organization. And what it does, it takes into account of the correlation of the risk. It binds together the entire organization. It consider the risk appetite of the organization and help in decision making. It also help in optimizing the capital requirement. These are some of the advantages of the enterprise risk management. Why we are talking about the enterprise risk management? Because uh, this research have been conducted from the point of view of the enterprise risk management. Also, silo risk management is not in existence. Having said this, there is still a confusion between risk management and enterprise risk management. Both are not same; they are different. Uh, so, also, no, just go back, Dr. Purnima. I would just like to share in this slide that what are the developments of the enterprise risk management over a period of time. These are the different standards, and if you can see that it started developing around year 2000, when various standards started coming. The COSO is one of the standards, and ISO 31000, and you can see that it came pretty late in 2004 and 2009, which is later revised in 2017 and 2018. So that's the development of various standards, risk management standards, that have been in existence now, and place the framework of having the enterprise risk management. Dr. Purnima, can we move to next slide? Yeah, this is the COSO framework. COSO framework has got 5 pillars: governance culture, strategy, objective setting, performance, review, revision, and information. And these has got the principles, and there are total 20 principles. And for an organization, different organizations across the world either have got a COSO or the ISO 31000. And any organization who has got the implementation, kind of they implement these principles. And once these principles are implemented and tested, then we can say that the organization has got the implementation of ERM framework. And we in our research adopted this COSO framework in testing the Indian market, that where they are standing in terms of implementation of the various practices against the COSO principles. So can we move to the next slide? So our study objective is that what are the ERM, enterprise risk management practices within the insurance industry in India? Uh, then quantifying the relationship between the determinants of ERM and the firm performance, because there has to be a monetary value should be there when we talk about the enterprise risk management. And when we apply the enterprise risk management, then what are the challenges in implementing those ERM practices within the market? So what we did, is that we have analyzed the published papers, published work of around 187 papers. We analyzed, which is published in the insurance sector and on the enterprise risk management in the world. And we analyzed, that how papers are published over a period of time. And you can see that the most of the papers started publishing around 1997 and 2002. It's started increasing from the global crisis 2008, and then sharply increasing over a period of time. And what is the geographic the concentration of the papers that have been published? It's mostly, in Europe, 38%, North America, 34%, Asia, 18%, but in Asia, it is mostly dominated by Singapore, Malaysia, and Australia. India is, very minuscule in terms of the exact number of peoples. We found during the period, that this period, we found only four papers were published. But of late, in last 2 3 years, more number of papers on the enterprise risk management from the Indian authors and the researchers have started, getting published. We also saw that, what are the types of paper that is getting published over a period of time, is mostly because initially when the enterprise risk management were in practice, were getting into, so most of the paper were, empirical papers. Researchers were, trying to understand the impact of ERM on the firm performances. Another were, on the conceptual side of the paper. So they were, consuming around 85% of the papers, and rest, were the other. If we, divide in terms of the three, areas like ERM, risk-based capital, and the risk management, then, this is the spread of, the distribution of the peoples. So this is, from the research point of view, that, how
I would like
the
to add one point here. While we are reviewing the research, that's not only the academic literature, we have also reviewed the industry literature as well. And here, what we found, like correctly pointed out by Dr. Sanjoy, that it's an empirical research, means quantified data-based research was more there. Database means number-based research was more there. But what we find, because ERM, that's been confusion happened with the journals as well. When we send our papers for a particular journal, they assume risks to be associated with the market risk or for the risk which is a global or macroeconomic risk. However, the ERM related, the risk we are talking about here in our research is an internal risk that's limited to the organization itself. And that risk is more about processes. That risk is not more about the numbers that are happening. That is more about the processes and how not having the right processes, not having the right check, not having the right decisions by the committees who are reviewing the different aspects or the strategic positions in the organizations, or how that is being impacted the financial aspect of it. That kind of questions were not being majorly answered in the literature, and that give us a gap that it requires two kind of data set to be reviewing in. Once, of course, the data that is there in the annual report, and second is the opinion of the risk professionals in the insurance industries. For that, we need to have an interview sessions with them. We have taken the surveys with the insurance professionals, specifically working into the risk department of the organization. Because ERM, if you'll see very closely, it's more about process, how all processes are going right. Because even if a single things get not as per as it should have been good, it imposes a risk for an organization, and ERM is all about controlling to it. And that's what we have identified, and that's why we have put in a triangulation technique, meaning we have gone through a mixed method research, collecting both quantitative and qualitative data, and then able to concise and call it consolidated our research to present, to actually fulfilling the research questions that right now being recently being shared by Sanjoy. Over to you, sir.
Yeah, Dr. Purnima, can we move to the next slide?
Yeah, please.
Yeah, so, this is the framework, that we adopted to perform the research. That, how does the various, the breaks are, connected. So, what are the determinants of enterprise risk management? And we found, these determinants through the literature review. That was literature, 187 papers that we studied. That we found that the board, the audit committee, the risk management committee, the firm size are basically, they influence, the enterprise risk man. They are the, determinants. And how does that influences the ERM practices? There are very, we talked about various COSO ERM practices. So what is the impact of these determinants on ERM practices? And what is then on the insurance company, how does that influences the firm performance? So for the firm performance, we took it separately for the life and non-life. For life, we considered expense ratio and solvency for common, and combined ratio for non-life because it is specific to non-life, and return on equity. So return on equity and combined ratio is kind of a measure of profitability. That's how, and why we considered expense ratio and solvency, because uh, mm, these two these two measures have not been researched by many researcher in the past at a global level. A lot of authors have researched on Tobin Q, which is the measure of the firm value. So therefore, we basically wanted to understand how does it impact the expense efficiency, the solvency, and the combined ratio and the return on equity. So that's the model that we have taken into the account while performing our research. And yeah, so next we can move
Just to
forward.
add on one thing, this
Yeah.
conceptual framework we developed based on the gaps that we have identified. So, this is one of its own kind of framework that we are being able to develop by connecting how the different committees can actually influence the financial health or performance of a company, where we see that how committee plays an important role, but they do play in setting up the right practices. So, yeah, let me move forward. Ah,
Yeah.
first.
Now let's move on to the results of of those three objectives. So what we did, to basically get the information that we had, gone for the survey, and we had, identified uh, mm, based on the people responses that how does various the COSO practices are being followed within the insurance sector in India, and we basically took the opinion from all the three lines of defense of the people, so that that's what the enterprise risk management is all about. It is from top to bottom. It should be implemented, and there is a role of the first line, second line, and third line, and we therefore had the opinion of all the three lines of defense of the people. So if we look at the demographic details of the respondent, then it is 53% people were coming from the life insurance side, general insurance 26, and health 11. So roughly you can say that general insurance is roughly 37%, and 10% is coming from other brokers and consultant. In terms of the age range of the people, then 40 to 50, 44%, which is quite a mature population. 30 to 40, 37%, which is roughly comes out to be 81% population, greater than age 30. In terms of experience, if we look at greater than 20 years of experience, 18%, and 10 to 20 years of experience, 52%, which is roughly again, 70%, which, maps up with, with this experience. And in terms of, the positions, then we had, CEO, CRO, CXOs, head of role. Head of role, is basically both, under risk and, first line, and others means, the vice president, AVP, senior manager. So we had cut off at the level of the senior manager. So that's the demographic details. Yeah, Dr. Purnima,
Yeah,
let's move to the, yeah, you want to say
that's an
something?
interesting.
Okay. How to look at, because we analyzed the practices, that what are the various practices that the Indian, in the Indian insurance market is observed against the COSO pillars. And we have got the COSO pillar here. COSO pillar, governance and culture is the first pillar, and you can see some are green, some are orange. Green means that these are the the practices are followed as per the COSO, they align with the COSO framework. And orange means these are the areas of improvement that, and these were based on the scale on which the people had responded. And we saw that there are various principles under the COSO, like board oversight, operating structure, desired culture, retained talent. If we go back and look at the COSO framework, we shall find these principles. So we found that the board oversight, which is about having the risk management policies and practices, whether it is there or not. Yes, it is there. The board regularly analyze the past events. I mean, yes, it does. Whether ERM framework is regularly reviewed. Yes, it is reviewed. So these are the things. The organization's internal audit function is aligned with the risk management framework. Yes, it is. uh, the risk management function perform robust oversight and challenge the risk management activities of the first line. Yes, it is. Now, what are the the challenges that we observed, especially under the risk culture area? The risk management framework has a clearly documented list of key business areas. Especially it helps if the risk management framework is documented the decisions that the organization is to take based on the risk based decision. We ask the question whether it is there within your company or not. We found that it is inadequate in number. In terms of having the risk champion in every function, we could not find enough. The company set accountability and the responsibility of the risk management challenges in the job. That also we found it inadequate. And apart from these practices, we also have risk challenges in the one of the practices. And uh, these some of the practices where we have found the gap here, we also found similar gap in the challenges. Sorry. Yeah, we also found similar gap there. And these are different sets of people. They are not the same set of people who were into, because here the people who were given the, given the questions and who were answered, and in the another challenge areas we had interviewed the people. So those are different sets of people. So the different sets of people giving the same answers, which kind of validate our results that these are the practices that are the gaps or the practices that are being followed. The company incorporate risk management performance of employees in their annual appraisal. We found gap in this. The organizations has a risk management performance process uh, in place to identify reward appropriate to the risk behavior. The same issue, we found it in the risk challenges. The organization's governance structure reflect the influence of risk management on decision making. We found it, poor. Significant time and resources are allocated to the risk management training and skill building. I think this is also, need to be developed. Next slide. So this is about, the pillar one. Next, yeah. Under the pillar two, which is about the risk appetite, we found that the insurance companies are setting the risk appetite, right? Most of the companies, but the challenge comes when it is the use of risk appetite in taking the business decisions. So many of the insurance companies are not using risk appetite to take a decision. They are using it, risk appetite is making it, but not using it for the decision making purpose. Risk assessment and risk treatment is basically the fundamentals of the risk management, which is your risk identification and risk measurement. So that way we found it green. However, the employees are trained to utilize the risk assessment tool. There is a gap is there that employees are finding it. Not all employees are finding it easy to use the risk assessment tool. When it comes to review and revision, the organization's management compensation is linked with the risk management performance. I think this is clearly a red area. which is that risk management performances are not linked. But I remember that last year or so, regulator has initiated that board's compensation is going to be linked with the performance, but not for the entire employees. So IT solution risk reporting, we found it to be fine. The In the risk communication, risk related information readily available. There are challenges, in getting the information from the first line. That's not, easy. Risk information within the organization, both positive and negative, is rewarded. We asked this question whether it is done or not, and the answer that it came, is not onto that much of the positive side. So that's the about the risk management practices. Now I will hand over to Dr. Purnima to to discuss with you the next two objectives.
Thank you, sir. And somebody has right now put up a question in the chat box. So what we are discussing exactly the ERM functions in the context, risk functions in the context of insurance industry in India specifically. And this is a research conducted by Dr. Sonjai now and myself over a period of 4 years. And here we have tried to identify it because we find that gap that ERM is being not being considered into the risk function as explicitly as it should be, right? That's a bigger gap that we're able to identify. And here we are, ERM is inherited into the processes. So as an organization, specifically in the context of insurance industry, we try to delve it in terms of COSO framework, that what are the practices that are in alignment with the COSO, what it's saying. And this is being obtained with this extensive survey conducted over the management profession. That's the one part of it with respect to practices. What are the practices that are being followed, and what are those areas where the companies, the organization need to work on? Second aspect of this particular research is about, that's the findings that Dr. Sanjoy has recently been presented. And second aspect is about that how these ERM practices are actually connected with the firm's performance, because numbers also matters, financial performance also matters. And here we have taken certain variables, obviously with the help of literature, that what those variables will be. And these variables we have divided into three important buckets. One is the board variables, audit committee related variables, and risk management committee related variables. The data of this is very a tedious job to fetch that data, because all that data has been fetched from the annual reports of the different organizations. And we take firm size as a control factor while putting up the regression over here. And that's the independent variables for life and non-life in the insurance organizations. We have done it separately. For life, we have taken return on equity, solvency margin, and expense ratio. And for non-life, the other three ratios. Apart from equity, return on equity, we have taken combined ratio as a measure of profitability over here. These three ratios are being considered, and we have seen the impact of ERM over here. And that's the two-stage regression model is being developed. Another a very tedious work to do that, because here we are able to develop an ERM index, particularly an ERM score for the organizations collectively, so that if you can see at first what we have tried to do is that on the basis of these five independent variables, we have tried to find out their impact on ERM. And after getting this regression done, we have again seen the impact of these variables onto the firm performance by taking ERM as an independent variable. So that's a two-stage regression model being followed. And that's how the mathematics goes beyond this. First, with the help of equation 1, the value of ERM is computed. And then taking up the value of ERM from this equation, we have put that value as an independent variable into the second equation so that we can assess how ERM is controlling, or ERM practices is actually affecting the firm performance, financial firm performance in the form of expense ratio, solvency, return on equity, or combined ratios for both life insurance companies and non-life insurance companies as well. And that's how the kind of results that are being obtained. And for that, that's an interesting part of it. And I'm sincerely thanks Dr. Sanjoy to it, because that's a very tedious exercise. Both of us have actually does a lot of brainstorming over that, because you see how we'll calculate this ERM value. There is no index. There is no values. Like for ESG score, we have a score value coming up. Like we have in some indexes for some variables, but for ERM, we have no quantitative measure to measure it. So there are certain indexes being developed by different organizations. For example, S&P Global has developed a certain index. There are certain research papers are being formed where they have developed an ERM score. We have taken all these things into consideration and developed an average score, a score for ERM for all the different organizations, that is being taken into the consideration while preparing this whole quantitative model. So first of all, we have identified the different keywords with respect to COSO pillars that Dr. Sanjoy has mentioned earlier. Then we have searched extensively these keywords into the annual reports, and not only we study the keywords also with the help of count. We have studied the context, in under which context these keywords are written, and has they explicitly getting out of a meaning out of it, or just the company in the annual report has written on because they have to write it or something like that. So only then we have taken that keyword into consideration. Before that, we vet, after analyzing these whole keywords, we have vetted it through the different experts with respect to the ERM, who has an extensive experience into the ERM industry, ERM function. And if the company has implemented the keywords with respect to that for a particular pillar, we have given the score as 1, and otherwise it's a 0. And maximum score that any company can get out of it, it's 5, because COSO has 5 pillars. So that's how the whole methodology is being developed, and it is being done for every companies for all 5 years. We have studied the annual reports of all 55 companies taken into consideration, and 5 years annual report has been taken into consideration. That's a whole year exercise that is being done all manually throughout these 4 years. And after that, on the basis of that, that's an interesting composition coming up in terms of developing the ERM score. And you can see that, because I've said that maximum value can go up to 1. So achieving a score, though the data is of till 2021, because when we have conducted this research, the year was 2021 only. So we are now planning to extend it till now. But that's a result till the date of 2021. Maybe it hasn't improved in the last 2 years or so. So, but the average, the maximum score that was being achieved was at a close to 1.2, which is far more away from the score 5. So it means the ERM practices that is being mentioned into the COSO framework are still at their nascent stage, are still evolving, have not been settled. That is one implications, or one conclusion that we are getting out of here. So, and the ERM score in the life insurance industries is comparatively higher, and but the gap has been reduced over a period of time. If you can see that here in 2021, it's 1.20 and close to 1.04 over a period of time. But that's what we're seeing. It is still, we are still at the very nascent stage, and it will take time for ERM practices to get matured primarily into the insurance industry. That's one conclusion we have taken out of it. And on the basis of that score being produced, the regression models has been run, as I've told you. And these are the model descriptions that I've explained earlier. And the results, okay, I want to explain the results. The results that comes out specifically with respect to the statistical significance that they are having on the expense ratio, independent director committee has a positive influence. All 4 variables has a positive influence. In model 2, means the regression state second model, the board size and risk committee has a positive influence over the solvency ratio, and on return on equity. These 2 variables, board size and independent director dominance, has a positive influence on return on equity. And these variables, if you can see all these variables are directly contributing to the ERM score. So not explicitly ERM is coming up because the score is very low, but implicitly ERM in the form of these committees, because these are the committees which are responsible for stabilizing the risk-related practice, management-related practices into the organization. So therefore, it is implicitly being coming out that ERM practices play a very, very important role while maintaining the financial performance of a firm. And similarly, if I'll talk about non-life, specifically in the case of expense ratio, we're able to see that ERM has a positive influence. The higher the score it is, the expense ratio is getting reduced. And with respect to the other variables. And clearly with the quantification of the data that we have done based on the findings that we have fetched out from the annual reports clearly indicates that for an organization cannot stay away, cannot maintain its financial performance if the internal processes with respect to, specifically with respect to ERM, enterprises management domain is not being maintained in the right manner. And with this, that's the conclusion of the second part. So we'll see in the first part the kind of practices being followed, not followed. If not followed, what is the impact on ERM score they are ultimately getting? And that's how ERM score is actually impacting the firm performance. Now, question is that why it's not happening? Why, even if the COSO framework is known to all organizations, why the practice are not being implemented? Why not followed? So for that, extensive interviews being done with the risk management professionals over the three lines of defense to understand what are the implementation challenges. And these are some buckets we are presenting before you, which talks about that these are the challenges the organizations are actually facing in terms of its implementation. There are too many risks. They're not able to identifying too many risks, and now consolidation becomes an issue for them. Getting data from the first line of defense, because first line of defense are the front end people, from them getting the right results, from them getting them to understand the role they are into and how they can lead to the risk the company can get into, it's difficult. So getting data from first line top management people has a struggle to it. Identifying the roles and responsibilities, that is not being there. That's some clear roles and responsibility in terms of risk management function is being defined over here. Again, CRO reporting culture, there is a duality in that kind of, we have a CEO as well, we have a CFO as well, we have a CRO as well. So chief establishing the importance, the role of chief risk officer in terms of reporting structure of risk related matter is also a challenge right now. The companies are seeing it and observing. And training, another important aspect is training. We train on various aspects. We train on various softwares. We train on various training needs are there. But how your organization, your employees are being get trained into understanding the risk management things, that is not being adequate. And people have mentioned it very explicitly in the interview. And here, right now, the risk management is very reactive in nature. Whenever a situation comes, people start applying it. It needs to become proactive to actually get the cushion that organizations actually required. And yeah, right now, another challenge they face the quantification of non-financial risk, because ERM is primarily not directly related to its non-financial risk primarily. How the process-related risk is being quantified, and this is what, by way of developing ERM score, we have to go through a very tedious process. Very, very important point I'll talk you about risk culture. Organizations have culture, risk-related culture, that is also being in nascent stage, and if the right word is that underdeveloped in nature. And the other thing that I would like you to pay attention is that inadequate risk reward. The awarding people who are actually identifying and helping organization in proactively reacting towards the risk management kind of thing, it should be reward based thing, which is right now not there into this thing. And the concept of risk champion, we have a champion in every domain of finance, marketing, HR, purchase department, HR, operations, but with respect to the risk being as a department and risk champion, the concept is developing. We are not saying that's not there, it's a developing kind of thing. And an education on ERM, it is very, very required. People to get trained on enterprise risk management kind of thing. And it is all about understanding the organizational processes and the kind of risk can get it out from each processes. That's the basic summary of the ERM related implementation challenges. And with this, I would like to invite Dr. Sonjai once again to tell us that he has also studied the global markets. So we would also like to highlight that what other challenges that the ERM related challenges that global markets are facing and how they are common to us, and what are the differences that existed from here. Over to you, sir.
Thanks, Dr. Purnima. Just I would like to add one thing while you were speaking. Uh, well, when we were researching on this particular area of challenges, there are very few, researchers who have worked on identifying the implementation challenges across the globe. We found very few papers when we were looking at what how they have developed and what are the different areas. I think most of the papers that we found were coming from the construction industry, that they have identified what are the implementation challenges, and very few people came from the insurance sector. So that was a bit of a surprise. And recently, once I finished my this PhD, and I was going through a few papers, and got a couple of things that recently have got published, and got interested to see that what are the challenges in their country. And some of the challenges are similar in nature. This is about ERM challenges, not in the insurance market, but in the Colombo Stock Exchange of Sri Lanka. Right. You can see, the respondents perceive that the use of adequate information to make risk-based decision making as a great challenge. I think same, challenges there in our market as well. Lack of availability of the updated and timely information. The same challenge, because getting data from the first line is a challenge. Uh, that it is needed, to establish the formal system of risk information that could facilitate the management of risk aligned decision making. I think in the previous slide there was one, when first line is finding it hard to get, sorry, second line is getting hard to get the data from the first line. One of the suggestions that came that there should be a centralized database from where they can directly pick the information, and we can see that the similar thing is coming from Sri Lanka. Lack of top management support for the ERM implementation. I think this is nothing different than what we have seen in our market. And then of course a strong risk culture within the organization is the need of the hour. I think world across, all the regulators, all the top regulators of the world are talking of developing the risk culture. So this is one of the global kind of issue that is rising of developing the risk culture. Dr. Purnima, can you move to the next slide, please? Yeah, this is just the three bullet points. I got it. This is about in the East European countries, in the health insurance sector. So the first is the lack of computer program for the risk analysis. Risk management culture. Again, it comes the question of a culture, and then risk management knowledge at the management level. So at least two of the three challenges are similar in our country. Can we move to the next slide? This is coming from a very recent report. This is a McKinsey report. I was reading in December. This is a November McKinsey report, elevating the risk function, a strategic advantage, from the McKinsey of the European insurers. This is an interesting report, and I have also written a paper and given to Dr. Rakesh to compare, European insurers, position as well as the Indian positions, so that we can see that where they are and where we are. Uh, mm, let's shortage of skilled personals. There challenges slightly on a different plane, hindrance to fully capitalize on opportunities on artificial intelligence and generative AI. They have got a problem here, but we have got a problem at a bit fundamental level. uh, Alongside the talent, respondents said that the increasing data analytics and data interconnectivity across the product and platform is critical. The risk team should understand the key risks facing the carrier, uh, credibly challenge the internal policy. This is talking about the roles and responsibilities of the risk team. As for the actual role of the chief risk officer, alongside the risk-based decision making, managing the relationship with the CEO and the board of director. Again, they are talking about the roles and responsibilities of the CRO. One important thing, that I found, which is, I think, not there in India, is about, the veto power of the chief risk officer. They are talking of only 34% of the surveys participant said that second line has a veto power. I have not, seen in my working career that any of the chief risk officer in India has got any other veto power. So this is, one thing that need to be, explored. But it is not easy to, implement. Half of the respondents said that, sorry, half of the respondents said that CRO is fully and consistently involved in the strategic decision making. So that's, one of the outcomes that, they found it. So some of the things, which is there in the European insurers, is there, within India. Can we move to the next slide, please? Now comes, that we have discussed that the three, things that we have discussed. Now the question comes next: what next? Should we, stop here? um, we saw, that during COVID-19 there was a losses to the reinsurer. Climate risk is round the corner. Interest risk, can explode, and there could be, another pandemic. So what we should do? So if you look at, the ERM score is 1.2 maximum, is out of 5. 5 means, there were 5 pillars, and on an average it's 1.2. It means that on an average our industry has implemented one COSO pillar out of the 5, which is too low for the industry. And this is in fact, the implementation. So I think, this is where there's a need to implement. There's definitely a need to improve the implementation of the ERM within the industry. Now the question is that if we want to do that, uh, what are the things we have to do? We have to work on what are the gaps that we have, identified. And what are the gaps? The risk culture that require an improvement. We found that, the tone from the top, because we have done, though we have shared, this research, but we have got, much more detailed, areas where which have, each area by area we have gotten the numeric numbers, right? So tone from the top, that we have found that their frequency is, I think, is between somewhere half yearly to 1 year, right? Which is, insufficient to develop the risk culture. Risk reward, behavior and the risk based decision making. I think, this is absolute necessary. Training and skill building, again, the fundamentals. Without this, enterprise risk management cannot be developed. Risk appetite, is there, but is not being used for the decision making. Risk tool, how to use the risk assessment tool, that's a gap that we found. I think there is a greater need. Just said, that link the compensation. Whenever the compensation is linked to, it become very easy in an organization to implement something, because the bonus and the increment become at stake. In most of the European companies, in European countries, in the risk management areas, the bonuses are, linked with, the performance of the risk management. I think there is a greater need to linking the compensation of all the employees, not just the CXOs, but all the employees with the performance of the risk management. Uh, Risk related information from the first line, this and this point, centralized database is linked, because I have myself, worked in the risk management function for around a decade, and I know, the challenges of, getting the data. Reward of both positive and negative behavior. This is one of the elements, fundamental areas for developing the risk culture. This is according to the Institute of Risk Management Risk Culture Guidelines. Uh, Identification of focused risk. I think we found that many companies, are identifying too many risks, which deviates the risk, the focus from the key risks. developing the risk understanding, and measuring the non-financial risk. So these are the the key areas which Indian insurance industry need to work. That is on the first side of it. When we move to the the second side of it, which is the linkaging of on the quantitative side. Dr. Purnima, can you move to the next slide? Yeah, I wanted to focus that see, one thing that we haven't touched upon here, that the results, if we look at uh, the Indian, the expense ratio, if we look at, you can see a lot of variables are impacting, helping to reduce the expense ratio compared to the other the financial parameters. It also it indicates that expense ratio, because regulator over last 10 years have been working towards reducing the operating expenses. And there, I think there, the hard work in terms of forcing the insurance companies in reducing the expenses have paid off by so many variables are helping to reduce the expense ratio both for life and non-life companies, which is a good sign for the Indian insurance market. And also confirming the regulators effort that that it has paid off what they have started doing since 2016. Now the question comes that but the same number of variables is not visible for the solvency margin and the return on equity. And if we move to the next slide, the same is true. Doctor, yeah, if same is true, in case of non-life, that many of the variables is helping in the expense ratio, but not in terms of solvency and combined ratio. If we move to the next slide, so there's a need to work on here, because these are the driving factors, the determinants of ERM. And these people have to basically focus on enhancing the ERM practices, so that it start impacting. Currently it is impacting the expense ratio, but now questions about the solvency and the return on capital and the on combined ratio. uh, the impact is there, it is helping, but only few variables are helping, not all. So there is a lot of room for improvement in terms of more of the variables of the ERM practices. So there is a need to push. Dr. Purnima, can you move to the next slide? Again, the same picturization is coming here. It is the determinants of ERM here, impact, having the ERM in between. So once these factors works, the ERM score will go up, shoot up, and ERM performance should improve. That's the expectation, right? And I yeah just, and this is same being represented by the same equation that we are talking of. uh, this is also be said that risk based capital is round the corner, right? We hope that once risk based capital is implemented, we hope that that start improving the solvency margin. But that will be down 5 years down the line. uh, the moral of the story is that the ERM practices need to be improved. Can we move to the next slide, Dr. Purnima? I think we should end. Yeah. So the moral of the story is that we have to improve the enterprise risk management, so that it improves, the firm performance. The quantitatively, there is an impact being seen. So based on what currently we have implemented over the last 10 years, 8, 8, 9, 10 years time. This is what we have, but yes, we have also found the gaps, and that gaps need to be filled up.
Uh,
So
there
Dr.
are
Purnima,
many
you
questions,
add
Dr.
anything?
There are questions, and I believe we can take it up one by one. And one more thing before that, we'll take up the questions. I would like to highlight over here is that disclosure of ERM practices, because while we are doing this research, we find out it was very difficult to identify the right practices, the kind of work that the organization are doing with respect to framework. That's That's something with respect to disclosure, I believe that regulators need to see, because see, if the kind of risk management related practices or disclosures are being there in the annual report in a specific manner, as an investor, if I'm reading that, that will put in another confidence into me while investing into a particular company, and that gives another advantage to the company itself while they're disclosing these practices, in terms of putting up the investors confidence as well. So that is another thing that we observe, that these are not very explicitly mentioned. There is a detailed thing, but as in layman who want to search, who was to invest, and you want to look at these kind of things, and this is also not being highlighted by the even professionals, trade professionals, when they give advice to invest in, that how to look forward for the internal processes and the risk management related things that companies are putting into, because that will give in another level of confidence in terms of companies' sustainability and stability, with respect to the years ahead. There are certain questions that we can take one by one, and let's.
I think I'll request participants who have questions, they can raise hand and they can unmute themselves to ask the questions.
Sure.
Meanwhile, Dr. Sonjai, thanks for the excellent presentation, Dr. Sonjai and Dr. Purnima, and good insights. So as we're talking about the veto power to be used by CROs in terms of decision making, so I think that is a very important topic. But because what happens is, if the CRO comes across anything, he submits the report to the board, and to act or not to act depends on the board. It is prerogative of the board. So I think the CRO or the risk department should get some more power to take decisions, because this post-COVID, if you can highlight what had been the change, because COVID has, I think, transformed this. Taking the decision at the right time is the key. So what is your take on that? How we need to more empower the CROs and the risk department in the insurance company or in any company? Mr. Sanjay.
Yeah. So, Dr. Rakesh, this is a very, very good question, right? It is very close to my heart. Right. I think, see, veto depends upon two things. In any organization, right? Giving powers to CRO, right? Uh, Two entities are most important. One is the regulator, and second is the board. One of them is to step up. Either the board has to come up and say that, because I have worked in one of the companies where there are very strong internal influence were there, and it was as good as I will not say veto, but it was very strong. Right. So either the board step up and say that we give protection. It is kind of a protection to CRO, right? Otherwise CRO is hanging between the two pillars, right? Or regulator provide that in terms of that the CRO uh, has to give its you know he has or she has got the power to override certain decisions, and only to be overwritten by the board and not by the CEO. Because the challenge comes when the reporting structure, because that's what we saw it, and this is a global issue, where half of the world is divided that the CRO should report to board, and another half of the world says that no, it is report to CEO, right? So it is an unanswered question. But from the veto power, I think either the regulator or the board has to come up forward and make CRO more powerful, and give it more
Yeah,
this thing.
I think the role of board would be more important, because regulator may not directly influence that, but at least board should take a call that the report of or the findings of the CRO should be taken into account. Uh, Manoj Pandeyji, you can just unmute and ask the question.
Good afternoon, Sanjay ji and Purnima ma'am. Very good presentation, particularly of a deep analysis of the Indian insurance industry. Hats up to you. My simple question is, your model was all about COSO, and it has got 5 pillars. I believe as a layman that all the pillars are not of same importance as far as the risk part is concerned. So when you say that the score was 1.2 out of 5, I mean, was there any weighted given weight given to different pillars, or all the pillars were treated same?
Sir, my take is that I will, let Dr. Purnima answer this question separately. My take is that when COSO framework is made, the COSO framework is not made based on any weights. When they have created 20 principles, they do not say, that first principle is more important than the last principle, right? And similarly, when any policies are
So, but
created,
again, all the pillars are not having four principles. I mean, there is a difference in the number of principles also in the different pillars.
no. COSO principle, which is stated by the COSO.
Pillar.
Yeah. There are 5 pillars and 20 principles. There are 5 pillars and 20 principles are there within the 5 pillars, right? Right.
Yes, yes.
I am saying that had there been a different weightages, COSO would have stated that the first pillar is more important than the last pillar. What I am trying to state that in my assessment, all the pillars are equally important. That is what my assessment is. Right? It cannot happen that some of the pillars or some of the principles are less important than the other. Had it been, that should not be in those pillars. It should sit separately as a subset of something, right? That's what my take is. I would ask
Uh,
Purnima to
yeah, yeah.
have her views.
So, Manojji, when we were discovering that how we are going to calculate, because this regression model requires ERM as a quantification measures for us, we need some quantifying data. So when we were discovering, this methodology is not being derived by us only, right? We have studied several processes. One, through the literature that is being established. Second, S&P has also developed an ERM score methodology. They have also developed on a scale rate of 1 to 5 only. And there also we have, when we have combined all those methodology and then see how we can do it for on ourselves. First of all, with respect to weightage, that was nowhere mentioned that which one to give weightage, because when we have to assign weightage, particularly in research specifically, we need to actually have some reference to it. When even we have, when we are talking to the individuals as well, like CRO level people or the people who are into risk management, neither they have mentioned that you give, let's say, 50% weightage to pillar number 1 or 20% to this and 30% to that kind of weighted scoring, because in research then you need to prove it that why you were doing it. So that kind of references, because I'm talking from completely from an research point of view here, that kind of references we were not able to gather, or we don't have that. Even we were discussing that how the all pillars were equal, what we will do, because there are more principles, primarily more pointers in pillar number 1 and less in others. But how we do go about when we are giving weightage? Do we give weightage as per the number of aspects assigned to one pillar? How do we go about it? So when we'll see the overall methodologies being published with respect to ARM score, no one has given certain weightages to them. So that's why we have also adopted and gone through that particular approach that we have used.
Thank you, ma'am. Thank you, Sanjay ji.
Yeah, Ms. Rajsri, can you just unmute and answer the question?
Good evening, RMAI team. Many thanks to Sanjay sir and Purnima Rao for this wonderful session. I really enjoyed it. So to start with my question, my question one will be, like, since Indian insurance market is now trying to move towards a risk-based capital approach, then how ERM will it effectively impact ERM in a positive manner? That is what I would like to hear from you researchers as one of the things. And the second thing is, we all know that insurance companies are being rated by rating agencies like ICRA, CRISIL, etc., which predominantly considers credit risk. And this is just a thought process from my end. What if those credit rating agencies integrate ERM practices as well, so that it could significantly reduce some regulatory burden from IRDI perspective. And since credit rating is very important for any financial institution, insurance companies will also look forward to implement proper ERM practices as they are getting regulated by credit rating agencies. So kindly share your insights, please.
If I may go first for your second question, because that is also our recommendation to the policymakers in our research, that ERM should also be taken care of, because I'm telling you what is my understanding out of it as an investor as well, while investing into a particular company. Because what credit rating agencies do, they give certain ratings and that will be published to the investors, and investors take decisions accordingly. Okay, I'm going to invest, I'm not going to invest, but they don't consider that ERM part into it, which is a very, very important part while understanding the future sustainability of a particular business. And that's our recommendation to the policymaker through this research as well. So bang on to the point that you're also able to identify, because that's we are also recommending, because that is an important part. Until and unless your operational risk, your business risk, your internal processes are not are not in an are not being monitored, and investors knows that they are being monitored in a right manner, there is a disclosure to it, that gives in another level of confidence and allows firms as well to perform in a much better way, and that reduce the risk of scams as well into the organization. The early check-in points are also being caught on. And with respect to this your first question, and I would also like Sanjoy sir to reflect his views on that risk-based capital, whenever a minimum capital requirement is being put up by IDA, right, automatically you are giving much cushion to the industry to get into a more riskier zone because of the capital that you are having, right? So I believe that it will support, it will provide the cushion to the insurance or any other financial institutions when the amount of risk-based capital has been enhanced by the regulator. So that will also actually push up the ERM practices, because anyways there are two aspects of it. When we have more capital to stay to get it with us, we are having a limited capital to get into investment zone. So their companies again become very cautious in terms of lending or in terms of giving it to others, and taking all those precautions very cautiously, again following the principle of enterprise risk management. That's what my take on that. Over to you, Sanjay.
Yeah, Rajshri ji, very good question, and we have dealt this in our thesis. See, what is risk-based capital? Risk-based capital is that the insurance company is going to keep the capital based on the risk they are going to take. Right? This is a simple, fundamental that is going to be the shift from the current position. Now, look at the shareholders. Shareholder want that they would like to, put the minimum capital into the insurance business. So what they will do? They will tell, that they want to minimize the risk. How they will minimize the risk? By enhancing the risk management. So what will happen once RBC comes? Instead of the regulator, now shareholder will push the CEO and the CFO to enhance the CRO's position that we are talking about, the veto. If the veto may not come, then I am sure that enterprise risk management within every insurance company is going to get up at least one or two notches up. It has to be done. Otherwise, think about the shareholders, the if so it will be a reverse position for them. And it has happened in all the companies. If you have heard about the three pillar approach in Solvency 2, right? What is the first pillar? First pillar is the calculation. What is the second pillar? Second pillar is disclosure and risk management. So any risk-based capital approach, has got enterprise risk management embedded within any, whether it is banking sector or it is the insurance sector. Without this, RBC cannot survive. But
Thanks.
insurance sector can survive without ERM because they do not have, the risk-based capital.
you so much for your insights. Thank you.
Yeah, Mr. Amit Kyal, can you unmute and go for the question?
Yeah. Yeah. Good evening, gentlemen. Thank you, Sanjay sir. Thank you, Purnima. Thank you, Rakesh sir, for conducting such a informative session. I just wanted to share one information was that probably in context to Nepal, that life insurance companies here have already implemented the risk-based capital regime. And sir, I just wanted to share a feedback that we gone 100% live with the risk-based capital regime in context to Nepal. And with Nepal life insurance companies, what we observed is that there is immense amount of capital requirement which is coming into picture. And the difficult part and the challenge part, which I feel, is that just because of the risk management framework, the capital employed and those part has been started escalating. And eventually I feel that it would be a challenge for shareholders or the other promoters to take on to the business, because the capital injection will always be higher and higher, because till the time we don't mitigate the risk. So it's one of the bigger challenge, I think. So it's the high time that probably the risk management framework has to be implemented into the business operation and those aspects. My question was mainly in relating to the slide, sir. In one of the slide where you mentioned that there is immense amount of challenges. Every countries across the the insurance companies across the regions are experiencing the similar or a different kind of nature. I just wanted to understand that how would you suggest, what are the solutions for those things, those challenges actually? And those challenges, when it comes to my mind, I could see those challenges could be because of the IT system making better, because you can have a central database to have a informative, and where first line of defense can act immediately. That could be one. The second could be we can make board responsible, the chairman, the other directors, the independent director is a responsible person. The third could be regulators actually. So I could see that there are bits and pieces of kind of solution, but I just wanted to understand from you experts that whom would you say that these are the first three solution where the most of the solution can come, whether it has to be regulatory prescribing these challenges to be taken care by the company. So what could be the way of solution to address all those challenges? It will not come in immediately 1 year time or 6 months time, but there has to be a preparedness that okay, we in one point of time we will reach to those solutions. So I just wanted to understand those solution, the progress or the pyramid, that how those solution will come into picture.
Yeah, for that, you have to appoint a consultant, right? To prescribe a solution. Right. I think you have basically answered the question yourself, to be honest, because the answer is not in one piece, right? There are so many pieces are connected together, and the onus around so many people, because that is why it is enterprise wide. Had it not been enterprise wide, there would have not been any problem. One people, one element would have solved the problem. There are so many elements. It all starts from the board,
It's all
or
start from the
even before the board, it starts from the regulator. They set up the various guidelines. That becomes the stepping stone of the game. That plays the rule of the game. If you look at the rule of the game today in one part of the country versus in Europe versus in America, you will find it different. And we'll find the ERM practices are different in different countries. So you are right that the similar challenges are there. But what we are missing is the quantum. There may be a risk culture challenge in India, in Bangladesh, in Sri Lanka, in Nepal, and in London or in UK. But the quantum could be different. The nature could be different. Right. So the question is that by just saying that this is a challenge does not mean that our challenge and their challenges are same. The challenges could be different in terms of the strength, and that strength we do not know. But coming back to your question, of course regulator is going to create the rule of the game. Board is to basically ensure. I give the example of the expense operating expenses. Indian regulator were, very, very, they have been last 10, 15 years have been, just on the insurance company. And, that result is being shown here in our result, right? So the board, comes into the picture, board audit committee and the risk management committee. Then it comes the ownership of the CXOs, because there has to be a, you can say, the ownership of the risk. The ownership of the risk is not with the CRO. Every risk owner is the first line of defense. Do they understand? That's the whole question. I don't think, people understand who is the owner of the risk, right? What is the risk culture? What is the risk, tone from the top? So it is, I think, if you go to, the Australian regulators website, they have really struggled. They have created, the 5-year plan for, some of the banks, which they identified that, they had troubles within their, the banking system, and they created 5-year plan and created, independent, bodies to ensure that those things are implemented. So it's not an easy thing. There is not a single solution. It is a very strict monitoring and implementation. Uh, Wish and will and, powers to the people. Only then, it is going to happen. And yes, it is, challenging. Uh, and of course, all those, the knowledge and the information. Uh, that's what, I can say it, in a short while. But yes, in many countries, such challenges have been, addressed. Australia is a good example. If you want, I can send you, those reports, because I had gone through myself with those reports. I'm just forgetting the bank's name, but they have, created a special plan for, getting back to green.
So just one kind of feedback. I don't know whether it is there in the ground or not, but as the World Bank is coming up with, the risk-based capital, and, in context to all the, the Asian countries also, they are, pitching, and, the NFRS, the IFRS 17 is, being implemented. In context to risk management also, if there is a similar kind of framework which can be, compulsorily be, routed through the regulators, trying to make them, aware and understand, and then eventually, that could be a right path. I'm just food for thought, I'm just sharing it.
I think, you're getting one level deeper into the risk management discussion, right? That is, a separate level of the discussion, because there are, another level of challenges still exist even within the risk management frameworks, and therefore, I'm talking of, this is the one layer further down. There is a robust framework in the world which totally protects any organization, whether it is COSO or it is ISO 31000.
One thing I would like just to add on to this, that risk will is always an inherited part of all businesses and in our lives as well. It will always be there. Point is this, for research perspective, I can comment on, primarily we need to identify the right levers for the kind of continuously existing risks that exist, and that how we can control them. You can ever never zero down any kind of risk. They will always be there. We can only control them. And technology is one such lever that you have identified. There is one more thing, and I believe that's a very ground level thing that I'm talking about, because who manages risk? It's the people who manages risk. People needs to give the right training, and the training, I'm talking about Indian education system here, being from academy as well, that the courses with respect to risk management, they are there in the online courses, short training courses, but they need to be the part of the mainstream curriculum as well. Though they are being there, but they are not being as popular as the other courses in different disciplines in management itself. So that is also as a part of even the companies, the kind of jobs they are proposing for, the kind of eligibility criteria and the JDs they are pushing up, they need to specifically come up with us as an academicians. Please train the young workforce into these areas. That is the thing that we want them to get trained on. So that is also one such thing, because until and unless it becomes the part how culture is being built up. culture is not built up in 1 day or 2 days or in a year or two. It takes in decades to build up a culture or an ecosystem. So that's why the ground reality start when the people who are being coming up into the organization, they are going to take it up. The technology, people, processes, and of course, other points you people have already mentioned, all together consolidately will play a major role in giving solution to those challenges probably that exist. Thank you.
Thank you, ma'am. Thank you. Really, I really appreciate your
talk,
this last academic feedback. Thank you for that.
we can
Yeah,
talk
Mr.
separately, right?
Yeah, Mr. Arjun, you can go next with the
Yes, sir.
question.
Very good evening. I'm very thankful to Rakesh sir, Sonaji sir, Purnima Rao ma'am. Hey, my question is, I'm working in one trading sector company as I'm doing audit there. So past day before yesterday, I was like, what has happened? Without knowing our accounts department, audit department, they sell the they sell the consignment to international trade. That is, they sell to Kuwait without e-way bill and duplicate invoice or everything. See, my question, what if anything the GST person captured or any person like or if custom people captured, it means a great risk to company capitals. Yes, no, what, how we can overcome with that and what we can do the process. It's the question we ask. The practically it's happened.
Sir, what I believe and what I understood from the question is that that's a completely process-oriented measure, and I believe in at organization there's certain SOPs set up for a particular process to happen, and here we need to check specifically in your specific case that has the SOPs being followed, has there has been loopholes that without being getting informed to accounts and GST department the bill can be passed. So it is all about process checking up. I've told you here in the chat as well that it's a process slippage and process leakage kind of example, which people and of course people are involved into it, and that's what the role of the training, the kind of lack of understanding the people have that what damage it can cause financially as well as reputational risk to the company if it has gone out. It's a lack of training to those people as well. So therefore, training is important to make them understand that they cannot do that. Otherwise, these are the kind of repercussion, because sometimes at that level, people don't understand repercussions and the consequences that can happen in a bigger way. So that's
So,
my take on it.
Okay.
so we are coming to the close of the session. So last one question maybe we can take. Mr. Stuart, are you there? Actually, I think he had a long question, so maybe we can reply him back later on. So if we don't have any more questions, we can close the today's discussion, because
Mr.
this sort of discussion may go
Mr.
on and on.
Mayank has raised the hand. Mr. Mayank
Okay,
Kumar.
okay, Mayank, you can please unmute and ask the question.
Yeah, first of all, thank you so much, sir. Thank you so much for this outstanding session. And sir, I'm a student of risk management, and uh, before asking a question, let me share you some thing related to my internship in public sector bank. So what I have seen there that public sector bank, apart from SBI, of course, they have this they are following this risk averse approach. They are more concentrated about their pillar one risk. So that is credit to market and operational risks. So my question related to this also, in insurance field, with public sector insurers holding about over 40% market share as per RDI 2023 report, facing evolving risks like climate change and cyber threats, how can they transition from siloed practice to an integrated ERM framework to enhance compliance, efficiency, and resilience?
Sanjay sir, you want to go ahead?
Uh, Dr. Rakesh, I have not fully understood the question.
Actually,
Yeah,
what the
So
question was,
can I
yeah,
re
yeah, Mayank, you can, yeah.
okay. So basically, what I have seen that public sector insurers and banks, they are much more risk averse in nature, because of course they
yes.
are being highly regulated, and they have to make sure that certain things fall in line.
Hmm.
So related to the insurance sector, we have seen the public sector insurers are having more than around 40% of market share. So
Hmm.
with emerging risks like climate changes and cyber threats, how can they transition from siloed practices to an integrated ERM framework to enhance their compliance and efficiency and resilience?
Okay, okay, okay.
Yeah.
So you're saying that how does the big insurers
Hmm.
can transition from the silo risk management to the enterprise risk management, right? That's
Yes.
what the
Yes.
question, right?
Yes, sir.
I think if I'm aware of the big players, right? And when we were looking at the annual reports of those big players, both in life and non-life, we found that because if you have seen um, mm, that the score of non-life is slightly lower than the life, and one of the reasons is that the public sector non-life companies have got a bigger say
Yes,
in
sir.
terms of their presence, in terms
Hmm.
of this thing. So they have started adopting the enterprise risk management, because we have gone through till the time we analyze the report. They have started following the enterprise risk management. They have got chief risk officers from
Hmm.
the the policies and these perspectives. They have um, they have established all those principles, policies. So they are there, but I think in terms of the implementation,
Hmm.
uh, for a big ship, it takes time to basically, make a move, and make it a note that the ERM is a new thing in the even in the Indian market. If you look at the our regulator, 2016 corporate governance guidelines of
Hmm.
regulator basically set in the ERM practices,
Hmm.
and many of the companies, even after that, they have set up the risk management function later on. So it's early days for some of those big players, but I think they are getting into it, and it depends, again on the board, and that how much time do they take. So but it's not that they are totally into the silo, but they have started moving. It starts from the top, setting up the CRO position, and then started implementing it. That's where that's what my take is. Dr. Purnima, what is your take?
Yeah, I agree. I agree because for the big companies, specifically PSUs, it can take their own understanding to infuse in the ERM into their regular practices that are being into there. But definitely, ERM is its way, and has to be the solution of to cater the risk management on its own. So yeah, and other things are being described by Dr. Sanjoy. Right.
So
Yeah.
I think we
Thank you,
are
sir.
coming to the close of the session. So first of all, sincere thanks to all participants who have joined not only from India but from Nepal, from Bangladesh, from and other countries, and for making such a interactive sessions. And definitely would be happy to conduct more such sessions to discuss and interact, because when you interact, things come out. It should be one way communication always does not is beneficial. So thanks everyone for joining, and thank you, Dr. Purnima, Dr. Sanjay Kumar, for an excellent session and excellent insights. So maybe in future we would be having some more session. And for the participants, we are organizing one more session on, I think, 18th. This would be on risk mitigation in accident claims with case histories. So we will share the details soon of the session. Maybe you can visit our website for the details. It would be on 18th of January. So thanks again, everyone, for joining and having an excellent session. Thank you, Dr. Sonjai. Thank you, Dr. Purnima, and everyone.
Thank you,
So see you
Dr.
soon.
Rakesh, and
See you soon
everyone
again.
for.
See you soon again. See you again.
Thank you, Dr. Rakesh, for arranging this, and thanks everyone for joining.
Sincere
Thank you.
Thank you.
Thank you.
Looking forward to connect you at different platforms, over LinkedIn or somewhere else, because mutual learning is always beneficial. And I also learned a lot through the questions that were being raised and we discussed. Thank you so much.
Thank you.